Hey dividend investors, I'm reading a book right now, Beating the Street by Peter Lynch. I love this book. I'm rereading it actually. This is the successor to One Up on Wall Street, which I'll link to in the pinned comment below. I've actually reviewed One Up on Wall Street on my YouTube channel here about dividend stock investing. In this book, Peter Lynch describes the stocks that he's owned over the years and how he's had many winners and many losers as well. I want to discuss a real loser in the video today. You could probably guess that it's 3M. But I want to start just with some winners actually to make myself feel better. So as you can see on the screen in front of you right now, Peter Lynch talks about how when you buy stocks, there's going to be some that exceed expectations and some, quite frankly, that will disappoint. And I'll tell you, Norfolk Southern has exceeded my expectations wildly. This is a stock that I started buying in 2013. They just increased the dividend by 8.9%. I'm yielding on my first tranche, simple yield on cost, 7.3%. I calculate that by taking the annual dividends looking forward and dividing by my initial purchase price. And so Norfolk Southern's doing really well. Kimberly Clark as well, quite frankly, 7.4% yield on cost on my first tranche, simple yield on cost, not counting reinvested dividends. Chevron's doing just fine too. And all three of these just increased their dividends just this week. So some really good news. But out of that bunch, what I would say, Norfolk Southern, that is the one that has exceeded my expectations. And in general, in the stock market, the way it works is our market is somewhat efficient, and so the stock is a representation of how well the company is doing. And so Norfolk Southern has done well, stock has gone up, dividend has gone up, everything is good. Same general trend as investors can look with Chevron over long periods of time and Kimberly Clark too. But over the last 10 years, 3M now has gone nowhere. And over the last 5 years or so, 3M has gone nowhere but down. Why is that? The underlying business, not only is it performing poorly, but in addition to performing poorly, the prospects looking forward are poor as well. And so I want to share with all of you in the video today some thoughts around 3M. I know I've talked about this stock on my channel a lot, and so I don't want to go into the stock in too much more detail than I have in the past, but I want to share some higher level lessons about dividend stock investing that can be illustrated through this particular case study. And so as you can see on the screen in front of you right now, the first thing that I want to share, this is only a snapshot in time. The modern portfolio that I share with all of you on Corner Patreon, I share a percentage allocation to each position over there and that I talk about here on my YouTube channel. This particular portfolio has really, the lion's share, been built over the last 14 years. I've had great performers and I've had some losers as well. This is really a smaller snapshot of time, and as a long-term investor, I need to remember that 14 years, quite frankly, is really short. And even when we talk about 3M going nowhere over the last 10 years in stock price, it's literally, the stock is the same as it was back in 2013, not counting dividends, just the stock, the equity. Is 10 years enough time to draw a conclusion on the company? Not necessarily, because over even longer periods of time, the stock chart is up and to the right. They have just hit a really, really rough patch. And so I think perspective is everything. And dividend stock investors have the luxury of looking at much longer periods of time than those who are trading stocks or buying low, selling high, that kind of thing. I'm in stocks forever. When I buy a stock, I permanently retire the shares, so to speak, because I buy those shares for the dividend alone. But I want to keep going. I have a few insights and then I'm going to get into the numbers. So the next insight I want to share, as you can see on the screen in front of you right now, is about the story of 3M. And so when I bought 3M, it was a high quality core stock, a premium dividend growth stock, like my core 4 stocks that I talk about all the time. My core 4, by the way, I'll link to it in the pinned comment below, but they're Starbucks, Johnson & Johnson, PepsiCo, and McDonald's. Also, a fun note for all of you, I'm going to have a little book club meetup on Corner Patreon on Zoom on February 2nd to talk about this book, Beating the Street by Peter Lynch. And so please mark that in your calendars and check out the pinned comment for a link to Corner Patreon as well. It's on the Corner Patron tier. Now, my story, though, with 3M is changing. When I bought it, it was a high-quality core premium dividend stock. Now my thesis is that it's a cyclical, contrarian value stock that has issues and longer-term probability of turnaround. Remember, one of the important things is a stock is a reflection of business performance, but sometimes the stock can overshoot both on the upside and on the downside. The business performance and the prospects at 3M right now are pretty darn bad, but the question is, has the stock overcompensated for that? I don't know if it has yet, quite frankly, but I think we're probably headed lower, and I could see that type of situation unfolding perhaps. And so for me, my thesis has completely changed around this stock, but I'm not a seller of the stock. For me, I'm going to continue to hold the stock, reinvest dividends, maybe buy a little bit more, but I want to keep going. As you can see on the screen in front of you right now, the next thing I want to share is is this a turnaround opportunity? And so Peter Lynch, one of my favorite things about this book, Beating the Street, is he talks about Fidelity Magellan being a growth fund. And in that growth fund, he had a lot of leeway to produce growth. He could produce growth really however he wanted, as long as he was buying stocks and investments that were generally defined in the prospectus for the fund. But sometimes he drove growth by buying high growth stocks. Sometimes he drove growth by buying small caps. Sometimes he found growth in commodities. Sometimes he drove growth or value for the fund by literally buying deep discount value turnaround plays. And so it was so interesting. One of his best investments of all time, where he went really heavy in Fidelity Magellan and did 50 times returns on his investment, was in the 1980s. And in the 1980s, when everyone literally hated Chrysler, he bought it. When they were on the brink of kind of going under, Lee Iacocca, the famous business executive from the auto industry, came in, turned around the company. Peter Lynch was really the only one buying it at that point. And I don't think we're there just yet with 3M, but I do think the sentiment out there is quite negative on this stock, and I think it could get to a point where is 3M going to be the modern day Chrysler. Now, of course, it's not going to go up 50 times in my humble opinion, but could it recover from where it's at? Could it get to a new all-time high one day? I certainly think so. If the right management comes in, the right activist investor comes in, calling all activist investors, if the right activist investor comes in and turns this thing around. But I don't want to count it out, and I think one of the greatest lessons from this book, from Peter Lynch's work, is really talking about the value sometimes of being the contrarian, and how a contrarian pick can sometimes drive growth. Even though it's not a growth stock, it's a value stock. But let's keep going. As you can see now in front of you, another thing that I want to share with all of you today, this is just all background information. This is kind of how I'm looking at what's going on right now. I don't know if this is helpful or not. By the way, I'm kind of under the weather, and so thanks for hanging in there. And I've also been traveling a lot for work. So again, thanks for hanging in there. I know the video production this time's not quite as polished as usual, but I want to get the video out to all of you. Warren Buffett. Warren Buffett said famously, only buy something that you'd be perfectly happy to hold it if the market shut down for 10 years. This is really important. I'm in this for the long run, and that's how I look at any stock, especially stock like 3M. I don't know where it's going to go in the next 10 years, quite frankly, but I kind of want to just forget it and look at it in 10 years as a contrarian value turnaround play. That's how I'm looking at it. And so I thought that quote was really relevant to the situation here with 3M. Even though I'm a dividend investor, sometimes I get caught up just tracking stock prices day to day. I shouldn't do that. I should be more like Warren Buffett, just set it and forget it, look at it in 10 years. I'm buying businesses, I'm not buying stocks, but I want to keep going. As you can see in front of you right now, the diversification is key. 3M is a larger position at 4.27% of my portfolio, but even if it falls in half from here, it's only going to drop my overall portfolio by 2.14%. So I think this is a valid reminder to dividend investors, to any kind of investor, that diversification, even in a dividend-centric portfolio, is so important, because we never know what will happen. And who would have thought just say 5 years ago that 3M would run into the kind of problems they are now? My whole thesis that it was an evergreen core growth story, not going to turn into some contrarian value turnaround story where the numbers are faltering. And I've been comparing it to the Chrysler of the 80s. Who would have ever thought that that would happen? The last thing I want to show you, as you can see on the screen, is I generally believe if they can get the earplug and PFAS issues resolved, I'm kind of looking at the dividend here as being somewhat secure. Now, I'm personally, what am I doing? I'm holding, reinvesting, and buying maybe a little more for cash flow with possible long-term equity upside. But at this point, I think they have a whole lot to overcome, and I think they've shocked the investment community with how bad things have gone, how quickly things have gone so bad. And the fact that it turned bad so quickly, hopefully it can turn to the upside. quickly if the right management team gets in there and fixes things, but you'll see that in some of the numbers today. Before I continue today, I'm going to get into some of the numbers in the video, but please go ahead and click the like button. It means the world to me. Again, I'm doing this video kind of under the weather, got a little cold. Thank you so much for hanging in there and for your support on my channel. Now, I want to keep going. As you can see in front of you, I want to do a quick snapshot of where we're at. Where we're at right now is the stock's at $112. This is down from a 52-week high of 175, so it's down 36%. But this stock is down 52% from the 2017 high. So this stock at this point would have to basically double to get back to its high. Could it do that? I think it could over very long periods of time, because it seems like they're facing some pretty big challenges right now with litigation around earplugs and with just the business being cyclical and weakening as we continue into this new year. The PE right now is a 13 when we look at the low end of the company's guidance for this year. It is a 12.55 when we look at the high end of the company's guidance this year. This is based on company guidance from their report that came out today. This is exciting to highlight here, and this is what attracts me to this company, at least to continue to hold it as a turnaround play, because this particular company right now is trading at such a low PE. Boy, that's really low for 3M. Now, if it got down to 10 or below, that's where I'd say, hey, this is a Chrysler kind of situation like Peter Lynch was looking at in the 80s. Having 3M trade like under 10, that would be almost unfathomable. And if it got to that point, that's probably where I'd start really buying more. But for now, it's more of a hold and reinvest and look at it as value turnaround kind of situation. Now, the dividend yield is 5.3% with a payout ratio of 70% on the low end of the guidance. And so I think the dividend is fine. And I'm personally just collecting and reinvesting the dividend right now. And so the dividend has grown at 4.9% on average over the last 5 years, but that will flatline from here, I believe. The market cap is actually really small at only $62 billion, and you can see some charts there where over the last 5 years it's down, and over the maximum period, though, it still is up and to the right, and that begs the question, did this particular company just get a little bit ahead of itself? Now it's coming back to reality. I'm not really a technical stock chart person, but it looks to me, at least in terms of the long term, that we're still talking about a winner here, but we're talking about a winner that has fallen on exceptionally hard times. By the way, if you enjoy these kind of videos, please go ahead and subscribe to my channel. That means the world to me. With the notification bell, I'm producing these new videos on YouTube, PPCE and dividend stock investing for everyone all the time. I want to close out the video today, and I want to go through some of the financial reports that 3M shared with all of us. So income statement, as you can see on the screen in front of you right now, the biggest thing I took away from this income statement is at the top of it, just kind of the operating income. It's actually in the year ended December 31st, 22 versus 21. They just reported the fourth quarter of 22 and they shared the full year. It's not down so bad. We're looking at like 7.3 billion in the 2021 year, 6.5 billion in the 2022 year. Doesn't look so bad. Like, why would the stock be down, say, 30 to 50%, depending on what time period we're looking at? Well, the reason is it's worse than it looks. If we go up a little bit, it looks like there's a large gain that they had on a business divestiture. And so actually that's masking how bad the numbers are. And we see this a little bit more in the cash flow, but what I'm trying to explain here is the cost of sales are up. The selling, general, and administrative expenses are way up. Research and development, which we generally want to go up, is actually down. And so long story short, operating income is down, but it's actually down a lot more, on the tune of $2.7 billion more than it's actually indicating in these numbers. And so I thought that was something that is just so important when looking at this. I would say overall, quite frankly, that is the main takeaway I had from the income statement overall. And we can see all the way at the bottom, the earnings per share, surprisingly, is not so bad. When we look at the year ended December 31st, we have basically earnings per share that are $10.18 versus $10.12, and that's just so surprising to see. I think part of that is because the share count is reducing, and I think, again, some of that is just because of some fancy footwork with the business divestiture. But I would say without the business divestiture, this income statement would have not looked so good, certainly at the bottom line or the top line. And so I think that's really important to set the stage that the company is slowing down and revenue is slowing down, but also the cost of getting business done is going up, so margins are shrinking. But the next thing I want to share is the balance sheet. As you can see on the screen in front of you right now, the key thing that I saw from the balance sheet is I was happy overall with what I saw. Overall, I saw that they were reducing long-term debt. It went from 16 billion down to 14 billion, so I liked seeing that. Now, I don't know what's included in other liabilities, but that was up. Overall, stockholders' equity was down. It wasn't down much, though, only a few $100 million. And so I like that they're keeping their stockholders' equity strong, and I like that they're reducing long-term debt. So if there is one good thing about 3M, I would say overall right now is that they're entering a terrible time, but they're doing it with a reasonable balance sheet. And so I would say that's good on 3M just as a quick balance sheet look. I want to look at cash flows next though. So as you can see on the screen in front of you, this is where things you can really see what's going on at the business. And the net cash provided by operating activities, this doesn't really include that gain from the business divestiture. So you can see just how bad it is. The cash from their operating activities is down from 7.4 billion all the way down to 5.591. And so this is a huge correction in the company's performance. And when the company's performance is so bad, of course, the stock is going to follow suit. The question, and please put in the comments below what you think. Do you think they've overreacted the stock price to what's happened so far, or it's kind of on par? I don't think we're at the point of overreaction yet. I think this business will turn around at some point, and I think that it'll be cyclical. I think value will be unlocked. I think it will get back on track as long as they can resolve the earplug litigation in a reasonable manner, and the PFAS business, they can exit that in a reasonable manner without any litigation related to it. I think that they will get back on track, but I don't think it's really overcorrected to the downside this point. That's my personal opinion, but I'm still holding because I do see some level of value there with the PE in the 12s and 13s. Anyway, let's keep going. As you can see on the screen in front of you right now, the next thing I want to share, I don't want to go into too much detail here. I'm trying to make this a little bit of a shorter video for all of you today and for myself because I got to get some sleep. But what I would say overall, dropping all the way to the bottom, is the cash and cash equivalents at the end of the period. It's basically going down. And so I would say from a cash flow standpoint, this company's cash flow is still great, but it's drying up. And quite frankly, the cash flow, though, that was generated, the 5.591 billion, a lot of it was eaten up in CapEx, which you can see CapEx is real. A lot of it was eaten up by paying dividends. A lot of it was eaten up by purchasing back their stock. And what was left at the end of the day? Basically nothing. I like it when there is something left at the end of the year. And so I'm not going to sugarcoat it. I've got a portfolio of 51 stocks. This stock has been one of the unexpected losers so far. And so that's the reality now. But the reality also is I've only owned this thing less than 10 years. And I'm only looking here at a company that's been faltering. It's back to where it was 10 years ago. That's kind of a shorter time horizon, quite frankly, in the history of such a powerful blue chip name. And so it will take many years or decades into the future to really see how this pans out. But let's keep going. As you can see in front of you right now, the next thing I want to share is the full year highlights. And so you can just see there, EPS is actually doing just fine. It was up on a GAAP basis, slightly down on an adjusted basis, but we'll see soon that this EPS looking forward is going to go down a lot more. And I think this EPS is masking some cash flow issues that we see deeper on cash flows. And I certainly think the business divestiture, as I mentioned, helped them quite a bit. I think organic sales growth is drying up. It's 1.2% year on year. They're seeing some headwinds, though, from a decline in the respirator demand and also an exit from the Russia market. And so obviously there's just a number of things hitting this company all at once. They received approximately $1 billion in consideration, and They reduced their outstanding shares for their food safety divestiture. You can see on the screen here, honestly, from their full year highlights, I don't have that much to say other than, quite frankly, that highlights screen doesn't really shed too much light into the low lights, which I tried to uncover on the few screens prior. But I want to share what's happening, what are they seeing happening in the year forward. So as you can see on the screen in front of you right now, this is where things get kind of nasty, and this is why the stock really has been tanking. And in particular, you can see on this screen, they expect adjusted earnings per share now to drop to the $8.50 to $9 range. So that's pretty low as compared to what they did in 2022. You can see that they're seeing a -6 to -2% adjusted sales growth, reflecting their -3% to flat adjusted organic sales growth. They're seeing issues from the respirator decline, exit of Russia. You're seeing a divestiture impact. You're seeing foreign currency impact. There is a lot working against this business, and this doesn't even talk about the massive litigation risk right now with the earplugs, and also possibly, but hopefully not, the PFAS exposure as well. And so, at least though on this outlook slide, I do think 3M is really honing in and drawing the investors' attention to that fact that the next year, it's not going to be the best year ever. The next year, it is going to be a rough year. And so let me know what you all think at home. Put in the comments below. You know what I'm doing here. I've kind of shared my own story, and my story, it's unfolding in real time. I'm learning more. But for me, just where I'm at as a dividend investor, I don't really trade stocks. I rarely sell stocks. And so for me, I've made my bet on this company. In reviewing the company, my thesis has completely changed, but I still see, for me at least, a valid reason to hold it. And it's not, oh, I'm just holding it because of the dividend. No, I'm holding it because I see a valuable business that is trading at a forward PE of 12 to 13 that could turn around. It could potentially be a double, say, over the next 5 or 10 years if we get a Lee Iacocca type leader into this company, or an activist like Lee who could turn things around, because quite frankly, I'm being a little disappointed with management right now and how this company has been run as long as I've been a shareholder. But it would be interesting, here, put in the comments, here's a fun question for all of you. What do you think Peter Lynch would do here? He's different than me. The biggest way he's different than me is he in his tenure at Fidelity Magellan, traded a lot of stocks in and out of positions. Doesn't just set it and forget it, hold them forever like me. I guess for me, I'm a little more like Buffett on that side of things. But let me know, just fun food for thought. What do you think Peter Lynch would do with 3M right here? And also put, what are you doing with it? I'll be interested to hear in the comments section below. All right, everyone, if you enjoyed the video today, please go ahead and click the like button. It means the world to me. And also don't forget to head on over to Patreon, if you corner Patreon, if you want to join the book club on February 2nd. I'll link to that in the pinned comment below. Before I go today, in terms of a full disclosure, I own the stocks mentioned today. I'm long 3M, ticker MMM. I'm long Norfolk Southern, NSC. I'm long Chevron, CVX. I'm long Kimberly Clark, KMB. I'm long Starbucks, SBUX, McDonald's, MCD, Johnson & Johnson, J&J, and PepsiCo, PEP. I own those stocks in my personal dividend stock portfolio. Before I go today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market, anywhere else, please consult your licensed financial advisor first. It's possible to lose money in the stock market, and we're seeing right now in volatile times as we head into a potentially rough year. 3M is already saying, hey, we're going to earn a lot less money this year than the last, and we're already having a lot of challenges. So we can just see here how tumultuous this stock market is. I'm just sharing my journey. I'm not a licensed financial advisor. I love you all. I appreciate your support, and I will see you in the comments below, and I will see you in the next dividend stock investing video.